Good day, everybody, clients and friends of MBP Sterling Partners. It's Jamie, and I'm back to give you our outlook for 2025. If you missed it, go click on the other video and check out our 2024 recap. You can have a look at what happened in 2024 and how it set us up for this outlook. So, what are we going to be looking at for 2025? Well, here's an agenda, a few of the themes. We're going to look at some policy volatility. We're going to look at the interest rate environment, tariffs, immigration, fiscal deregulation, country focus, and hopefully predict some of the themes that might happen in the markets next year. So, let's get started. Firstly, let's talk about policy volatility. We already know about the US election. It has happened, and the inauguration comes next week. So we're going to see the changeover of power happen pretty soon. But what we like to point out is that typically a policy change or an administration change between, say, Democrats and Republicans or liberals and conservatives, typically the policy change is somewhat modest between the two parties that are coming in. We like to think and point out that in the US case, there's a much wider differential between the policies of the outgoing Democrats and the incoming Republicans. And potentially in Canada, when we have an election, which is going to come sometime this year, potentially those policy changes are even wider. We've got a policy and set of governance in Canada that has gone quite far to the left, particularly economically. And no matter who leads the Liberals, or the conservatives, whoever wins one of those races, we see the possibility for pretty wide policy rifts between old and new. And this, of course, is going to have implications on the markets. So, what are some of these potential policy changes? In the US, we always know about taxes. That's what Trump has been running on, corporate taxes for quite some time. Tariffs have made a lot of noise, and trade, that's going to have big implications on the economy if they get put in place, which is a big if. Deregulation, mergers and acquisition, antitrust regulation, that all falls into the same bucket of a higher regulatory environment versus a lower regulatory environment that we expect. So that could bring us more mergers and acquisitions in the corporate world. It could bring us more initial public offerings and hopefully just a more robust corporate environment going forward. We've all heard about Doge, which is really just a meme way of talking about fiscal prudence and cutting the budget. So, is cutting really going to come in? These governments, that's the only thing they seem to be able to agree on left and right, is that they like to spend money. It is possible that that's coming to an end. We'll wait and see how successful they are at that. Immigration is a very important one. That's a policy that Trump actually ran on. One of the key policy campaign promises that he ran on. And we have a similar issue happening in Canada where immigration is a very hot button issue and it's going to be widely debated in the upcoming election. Crypto adoption is an interesting one, a little bit of a sidecar, but we find it interesting nonetheless because it is a financial instrument. And then, of course, health and food regulation. With Robert F. Kennedy Jr. being appointed in the Trump administration, he is promising big changes to come to the health, particularly the drug and food regulations. So that could have pretty big effects on industry going forward. Let's talk about the strategists. You might recall last year, and if you look at our 2024 look back, the strategists were, frankly, they got it wrong for the year. Last year, have a look at this top left chart. The strategists, on average, across the 20 strategists, the big Wall Street strategists that were polled, they predicted a mere 1% rise in the S&P 500 over the year, and 6 of the 20 predicted outright declines. And so really they thought nothing was going to happen. And you'll recall back then, all the talk was of recession, and it was not in vogue. It certainly wasn't the sentiment to predict higher markets. Well, we all know what happened. It was a huge year, 25% up on the S&P. So the strategists couldn't have been more wrong. What are they saying this year? Well, they're a little bit more optimistic. The average estimate comes in at a plus 12% to where we stood on December 31st. Only one of those strategists is predicting decline. I'm comfortable in predicting that they will likely be wrong again. So taking a look at this chart on the right, this shows the range year by year, the range of predicted outcomes that these strategists had for the market. So the pink bar shows the low and the high, and all the guesses in between of where the market would end up at the end of the year. And the black diamonds show where the market actually ended up. So you'll notice that the black diamond is often outside of the bars, or at the very least at the top or the bottom of those bars quite frequently, which means that the strategists are just generally wrong. They're usually not optimistic enough in up years, and they're almost always too optimistic in down years. The down years always exceed their expectations on the downside. So, why do we look at this at all if they're always wrong? Well, it's a good indication of sentiment. We like to watch where the sentiment is. This is the sentiment of the professionals, obviously. This is Wall Street. We'll talk a little bit about individual investor sentiment later on. But measuring the tea leaves on sentiment is an important part of understanding where the markets are likely to go. When we look at interest rate expectations, a few months ago, we had a very different story. The market was looking for pretty deep cuts in the overnight rate of the US and the Bank of Canada rate in Canada. So we went from about 3% expectations for the ultimate overnight rate in the US. That's come all the way up to about 4.25 right now. And in Canada, we used to be pricing in about a 2.25, and now we're pricing in a little bit more like 2.75. So expectations have come up. Interest rates in general during the quarter and for the start of this year have started to rise quite a bit. So those who were expecting deep cuts and for us to return back to that borderline zero environment, you're going to be disappointed. Now, we expect that this is going to be range bound. Rates are going to move up and down in this channel, call it 3 to 5% in the US and probably a little lower, 2 to 4 or so in Canada. And we expect these ranges to continue to hold and go up and down. There might be a reason where we see a breakout to the upside for some inflation, if some inflation picks up, or to the downside if we see a disinflationary environment. But our best guess is that it stays range bound, and we just happen to be at the top of that range right now. So for the past 15 years, the S&P and American stocks in general have been the place to be for higher returns. They've been outperforming for quite some time. This has not always been the case. Sometimes the rest of the world outperforms the US. You might recall from 2000 till 2008 or so, Canada was the toast of the world in terms of stock market returns, and it has bounced back and forth. But this latest 15-year run of US outperformance really shows that it is different this time. Whether that means it's forever or not remains to be seen. But US has maintained its dominance over the rest of the world. What has that turned into? Well, an expensive US market compared to the rest of the world. If the US is growing faster, people should be and are willing to pay higher valuations to buy those stocks. So you can see now the US is trading at a forward price earnings ratio of almost 27, and that puts it in the 87th percentile of historical observations, meaning it's more expensive than it's been for almost 90% of the time looking backwards. That doesn't necessarily mean there's a turning point on the horizon. Valuations are a pretty bad indication of timing the market, but it just means that you're paying up to enter this US market as opposed to the rest of the world that we see hovering around the mid-mark. Canada's not on here. It's trading at about 18 times forward earnings, which is a little bit above its historical average. So we aren't too worried about valuations, but we do like to point out that in order to follow this US dominant trend, you have to pay up to stay in that market. We've talked a lot about Canadian households and what are their outlook. Frankly, we've been a little bit negative. The debt in Canadian households is pretty large, especially compared to our US neighbors who have had their washout in 2008 through 2010. And they started to rebuild from there. We haven't. We've continued to build the debt. And what's happened is it has started to hurt GDP in Canada. More and more of Canadian spending is going towards mortgage servicing and interest as opposed to real spending, and that hurts the economy. So what happened last time we lagged the US this much in GDP per capita? Well, you'll look at the arrow here and you see that points towards the early 2000s, 2000, 2001 area. You might recall that our loonie was down low near the 63 to 62 cent mark at that point, where we had lagged the US so much in per capita GDP. Well, it looks like we're there again, and not surprisingly, our loonie has dropped into the 60s again. We're at about 69 now. So history is repeating itself in terms of where the currency has gone in relation to the productivity and the output per capita of households in Canada. So will this get fixed with policy changes? We certainly hope so. We would also point out that a weak loonie is a good thing. We talk about it like it's a negative, but really it's a good thing. It attracts investment. It makes us cheaper to the rest of the world. So in a certain element, the best cure for a cheap loonie is a cheap loonie. And hopefully that is true this cycle as it was in the last one. And we do see a resurgence of the loonie as it starts to attract foreign investment. This chart on the right shows the purchasing power parity of our currencies on a relative basis. And you can see again, loonies are cheap. The American dollar has risen in terms of its valuation. This is also known as the Big Mac Index, or a corollary to the Big Mac Index, which just shows you how many dollars in each country it takes you to buy a very normal product that is the same across the borders, like a Big Mac. Well, on the economy, we had been talking about the employment picture starting to look weak when we were in our Q3 wrap up about 3 months ago. It's actually changed a little bit. We've had a few strong employment reports. Even in Canada, employment has been picking up, and it looks like the unemployment rate has peaked out, at least temporarily here. Similarly, in the US, that has just remained strong. And that US recession probability that everybody was talking about a year ago, it was the reason that strategists were so bearish and only predicted a flat year. That probability has faded right away. So there is almost no talk about US recessions anymore. Google searches for recessions have dropped right down. And what we were talking about being potentially a soft landing looks like it's turned out to be no landing in the US. It is quite remarkable how fast this story has gone away. Does that mean it's gone away forever? No, it just means that people aren't talking about it anymore, and it's not on the radar of economists and traders. So the outlook is optimistic. As we said before, the optimism is not just on Wall Street. This is a chart of individuals and households' expectations for future stock prices. It is way up there. And we're not going to lie, this is normally a contrary indicator. This is the one you want to fade. If you see everybody loving stocks, it's time to start to fade away from it. But what we don't know is how different these surveys are now compared to years ago. In a world where everybody's getting their information quickly, meme stocks are all over the place. People are trading through apps and through Reddit, and they're trading crypto and stocks and things that didn't even exist before. Are these sentiment surveys really comparing apples to apples when we look at today's sentiment versus, say, 20 or 30 years ago? We'll never know, but we do know that overall the feeling is optimistic in the markets. So, what are the trends that are going to come this year? Well, our best guesses for what a couple of the interesting sectors of the market might be are listed below. Firstly, artificial intelligence. We think it'll have a second leg here, but a physical leg and attached to another leg in a body. We're talking about robotics here. Artificial intelligence built into robotics. Think about those Boston Dynamics robots doing your bidding, folding your laundry, cooking your dinner. We think that's going to start to take hold as we get into 2025 and be an investment focus looking forward. Nuclear energy has already seen a resurgence, both traditional nuclear and technology-focused nuclear in small modular reactors and new nuclear technologies. The thirst for energy that, in part, AI has created has led to a resurgent investment cycle in nuclear. So I think we're going to hear a lot about that in 2025. Similarly, hydrocarbon-based energy, so the old school burning oil and gas to create energy, it's been on the outs for quite some time, the better part of a decade now, and we're starting to see a little bit of resurgence in that space, particularly in the natural gas space, where there really is a low carbon approach to burning hydrocarbon-based fuels. Quantum computing is an interesting one. Google recently announced a big breakthrough in their quantum computing program, and it has set up the very few quantum computing companies and stocks that are out there. It's set them on fire. We think that this has the potential to push forward a venture cap cycle and really a bigger investment cycle into quantum investing and quantum computing. So we'll be keeping our eye on that trend going forward. And lastly, this isn't really an investment trend, but we have noticed the reversal of ESG. So a lot of the ESG focused policies in corporations, we think they've hit their peak in terms of how prominent they are for those corporations. This doesn't necessarily mean they still won't have their ESG programs and we won't focus on it as an investment theme. It'll just fade in terms of its importance. It might be the 10th page on the investor deck instead of the first page, as we've seen it so often in the last few years. That's it for the Outlook. So I wanted to leave you with a couple of cool tools. If you haven't used these already, you should really check them out. The first thing is Perplexity. If you are still searching with Google, you should really check out Perplexity. Perplexity.ai is an AI-based search engine. You can ask it anything you want, and it gives you an AI-based answer, and also points you to the internet pages where it found the answer. So you can do some real research after Perplexity gives you an answer. Similarly, on the AI front, download the Google Gemini app for your iPhone or your Android phone. It is a really cool AI app. You can talk to it, or you can type in your questions. You can have a conversation back and forth with it, just to quickly learn about things that these AI engines can learn and relay to you as it scrapes through the internet. So some of these AI tools are really quite neat. If you haven't played with them, these are two easy ways to dip your toe into the artificial intelligence landscape. That's all we've got for today, folks. So thank you for joining me. I hope you enjoyed our outlook. And as always, feel free to reach out and give us a ring. We'd love to hear from you.